In the past, when we talk to an energy supplier, they only ask about two questions. The first is about cost. The second is about resilience. But today, there's a third thing added on top of that, which is sustainable. People understand how to do the first thing together using existing technology, but people don't know when the third criteria is put on top, how to do that properly. It's very difficult to achieve at the same time. We want to invest in things that can address the three problems, hopefully at the same time.
Today's guest is Tony Sun. He is Director of Corporate Venture Capital at GC Ventures, which is PTT Global Chemicals' corporate venture arm, a $20 billion chemicals and materials company headquartered in Thailand. He leads North America investments, manages the venture portfolio, and oversees technology scouting and market intelligence to support emerging technologies.
So the reason why we still use a lot of petroleum as feedstock is because they are good. But at the same time, we also realize there's some problem with that, which we have started to see over the last 4 decades. So this is why I think diversification as risk mitigation is definitely very much needed. And so it's really down to us is about how we can select technology that can mitigate that timeline risk. I think everyone has their own vision. For us, our approach is we prefer to invest in platform technology. The key rationale about that is we don't want to bet on a specific product because product, especially if it's on a commodity, very likely will be following the commodity cycles.
In the next 5 years, what do you see are the most exciting investments that will actually see some returns by 2030?
That's a real good question, Kevin. I probably want to mention about one specific thing is
Hey, hello everyone. Welcome to FutureScale's Built to Scale, where we talk with thought leaders and industry experts on scaling tomorrow's technologies. Today, we're pleased to have join us Tony Sun, Director of Corporate Venture Capital for GC Ventures and Head of their North American Scouting and Investment Operations. So welcome, Tony. And first of all, tell us about GC Ventures, your parent company, and your role, mission, and focus areas.
Sure. Yeah. Thank you, Kevin, for having me. And so Tony Sun over here calling from Boston. As Kevin mentioned, I'm currently leading the GC Ventures activity in North America. So GC Ventures, we are the corporate venture arm of a chemical company out of Thailand. So the parent company is called PTT Global Chemical, which is the downstream petrochemical arm of the National Oil and Gas Energy Conglomerate of Thailand. So the ultimate parent company is called PTT, which is basically covers everything from upstream, downstream, all the way to utility. And again, as the chemical arm and especially as a venture arm of this chemical company, so our mandate is really to look at emerging technologies, mainly on the early stage side for chemicals, for materials and downstream polymers. So these are the areas that we play. And in North America, we have 10 portfolio companies plus LP positions in 4 funds as well. So thank you very much, Kevin, again for having me here.
Sure. Well, as being part of PTT and in particular GC, General Chemicals, right? What are the particular domains that you focus on that is of interest both to you and to the parent company?
From the venture side, I think there are 3 specific sectors and the chemicals that we of interest. The first is advanced materials. The second is circular economy. And the third is decarbonization. So that's the 3 areas. And because we are part of a broader ecosystem, like the PTT ecosystem, so outside the hardcore downstream chemical part, we are also interested in things like energy, future energy, AI applications in energy, the utilities. Again, that's not necessarily out of the GC Ventures pocket, but we do have a sister fund that we work super close with and on those topics as well.
Okay. So opportunities to kind of co-invest, I would say.
Yep. So these are the things, and also because specifically for me and my team, because we are the only CVC team that has a permanent US presence out of the sister fund. So a lot of those topics, although GC Ventures may not be the proper investment vehicle, but a lot of things also go through me. So I work and support very closely with our sister fund on the other topics as well.
Okay. Now, how long have you been with GC Ventures? I understand close to 9 years at this point, right?
Yeah. Almost 9 years now.
Okay. The reason I'm interested is that in terms of portfolio vintages for investment, you've seen almost the entire cycle of about 10 years or so. And given the fact that your parent company is in the oil and gas industry, How does the cycles within that particular industry affect your portfolio strategy and the way you look at venturing?
Yeah, thank you, Kevin. That's a really nice question. First, I don't think we have fully complete investment cycle yet. So we'll see how that goes eventually. But yes, we are in the commodity business, right? As well as, so this is where definitely the broader cycle have impact us. So for us, specifically for GC, crude oil, natural gas, biomass is our feedstock. So the volatility of pricing of those things definitely impact our margin, impact our operation, and eventually impact in our team as an investment. The way how we look at that is mainly from two angles. So that's also somehow, complement to what I was talking about the investment thesis. So the first is, we are looking at technologies that can complement or supplement our existing operation that can hopefully improve the efficiency. So like advanced materials, right? So that's one side. And then we are also, as a venture arm, because we are looking at things that are much longer cycle than a typical commodity cycle, which is 6 to 7 years. So we also look at things that can alternative to our feedstock. So this is why we have a lot of emphasis on decarbonization in circular economy, where let's say bioplastic, biopolymer, biomass as a feedstock is also something we look at. Depends on where we are in the specific cycle. I think the emphasis on those two high-level group technology are slightly different, but overall, these are all the things that we look on a daily basis.
Now, I did want to dive into that a little bit further down in the conversation, but given that you've mentioned alternative feedstocks, now would be a good time to bring that up. So in addition to petrol feedstocks, of course, over the last 20 years, there's been a lot of excitement and hope and hype about biofeedstocks, right? And of course, now with carbon capture, CCUS, as you mentioned, there's a possibility of CO2 being a feedstock. And in fact, there's been a lot of startups in this area as well. I mean, so when you think about these three different areas of feedstocks, I mean, what are your thoughts? What is your approach to that?
That's a really good question. I think that's a $1 trillion question. I don't think I have a silver bullet to answer in the next 30 seconds. I probably want to mention about one specific thing is, I think a couple of few years ago, the national energy company, not national, but the energy company of France, Total Energy. So they changed the logo in the design in a way that it used to be just one color. I forgot what that is. But nowadays, if you look at the logo, it's very colorful. It has a rainbow color across it. So the whole rationale about that is Total's vision is that the future of energy will be diversified. It's not about one thing, but about many things. So the reason why I mentioned that is I think that's not just about Total. I think that's something that the people have seen just across the board. So the reason why we still use a lot of petroleum as feedstock is because, they are good. The resource is there and we have optimized efficiency. But at the same time, we also realize there's some problems with that, which we have started to see over the last 2, 3, 4 decades. So this is why I think diversification as a risk mitigation is definitely very much needed. I think people will agree upon that. I think the nuance is, what's the percentage? Are we talking about 90% petrol versus 10% else, or 10% petrol versus 90% else? So I think that's kind of where different companies and different investment vehicles are designed for different purposes to make sure that we can achieve a smooth transition towards a more diversified future.
Right. Well, let's dive into that a little bit later, because I think that's really impactful in terms of understanding supply chain, downstream demand, and markets and how things adapt, right? But coming back to your investment activities, maybe you could talk about some of your investments. I mean, one that I'm aware of is Turnover Labs, which is in the CCUS space, and I think you've told me about a couple others, but I think our audience would be very interested in some of the investments that you've made.
Since we kind of mentioned about the 3 different sectors we operate in, I can probably give, some high level of from each. For advanced materials, one of the company we are backing is a company out of Boston called ActNano, and they make waterproof coatings for printed circuit board like PCBs. So the company, we've been backing the company since late 2019, early 2020, and they have found applications in protecting electric boards in EVs, in security cameras, in wearable electronics, and widely adopted by many different sectors. So, and then under circular economy, we have been backing quite a few bio-based chemical biopolymer companies. So one of the ones that are closer to commercialization is a company out of Seattle area called Tidal Vision. So their key business is to extract biodegradable polymer out of crab shells, shrimp shells. So it's a full circular story. And the application for that goes into wastewater treatment, agriculture, a wide range of different applications in agriculture, as well as coatings for textiles. So that's something. And then under decarbonization, other than Turnover Lab, which Kevin mentioned, which is a carbon utilization play, we also back a company in the space of carbon capture, so which does point source carbon capture. And the company is called Ardent out of Delaware. So they have a platform membrane technology that is specialized in industrial gas separation. Carbon capture is only one of the many applications they're targeting. So I think all three companies, again, together with many of our other portfolio, they are making significant progress. But these three are probably much closer to being commercialized.
Okay. Well, this might be a bit of a curveball. We are FSX in our own research are very bullish about the future of membrane technologies to kind of challenge the standard amine chemistries for carbon capture. I mean, does that mean we're in agreement and harmony, or what's your view of the evolution of carbon capture in terms of substrates and core technologies?
Carbon capture by itself is also such a big domain that we don't think there will be one solution that addresses all, right? And also, especially for the decarbonization supply chain is still forming, right? It's emerging. And there's so many applications people can address. So that's, and also, amine is definitely one of the more mature technologies that are definitely best suited to the big volume ones as of today. But however, they're not perfect. That's why we have a lot of innovations. So for things like membrane separation, they specialize in certain ranges and also for certain stream volume that have a lot more applications. Another key rationale why we back in that specific company is because membrane technology are typical platform technology. So other than carbon capture, they also have other use cases beyond carbon capture. So this is where we see a lot of way in terms of application diversification, because many of those applications will have very long development cycle and adoption cycle. So we definitely don't want to bet all our investment into one specific bet, and then want to make sure that the portfolio company, they have their own development roadmap that can address many different needs beyond just carbon capture. So that's kind of an angle of how we are looking at the problem.
Well, let's kind of helicopter up a little bit because one of the things that's always been interesting to me is CVCs versus VCs, right? Maybe it's not versus, but you know, with VCs, they're always looking for that big 10 bagger. They're looking for their portfolio effect, and you're looking for that as well as supplementing your current R&D, but also maybe innovating new areas of R&D for the parent company. So that means that you have to handle a lot of different stakeholders, right? And all the different associated goals. And working for a parent company in Thailand here in North America, how do you make all of the mechanics work? And then what do you see are some of the benefits and challenges to that particular situation?
I think I can talk hours and hours about a specific question because that's what I do of our job, right? Long story short. So first, I think I'm probably biased, but I'll say doing CVC properly is definitely a very complicated job. And also, again, I'm probably also biased, but I think this is also the best and also worst job out there. And because it's so complicated, I know I put a lot of words around that. The reason is CVC. And again, I will probably get back to this a little later, but I would say the thing is CVC sits at the intersection between different things. So for example, corporate versus startup, that's the most obvious one. And then we sit at the intersection between business collaboration and also on investment. And then, specific for me, I also see there's this Asian mindset versus US markets. So I think all those comes into different places. And sometimes I have to admit, pull me into different directions. And sometimes they are not exactly along the same way. But however, I'll say, it's really good, just goes down to the most fundamental things, right? So what is the fundamental? Because what we do is basically we are matchmakers, right? So we'll try to, put different puzzles together to have a good game over there, to have a good match. So what's the match? On one side is the market need, which a lot of time represent the innovation need from corporate. And then the other side is really the interesting technology innovations providers, which are the entrepreneurs that we deal on a daily basis. So a lot of time that we spend time is really just to be the mediator or facilitator, making sure that the two sides can look at each other in eyes to eyes through us, because we understand language from both. So we are the translator over there, making sure they understand each other so that get the deal done. Whether it's investment or it's a collaboration, joint venture, whatever that is. As long as people on both sides are happy, we're happy because we get credit out of that.
Got it. Got it. So, okay. So a lot of negotiations and peacemaking in addition to the investments itself. And so operating here in North America, there's obviously been a sea change between administrations here. So I'm curious about the One Big Beautiful Act and how has that affected the way you approach your investments?
That's a real good question. I trust that's also one of the hottest topic probably over the last few months, right? If not years. I'll say the answer to that is it definitely have impacted us in near term a little bit regarding how to support our portfolio company and also how to adjust us evaluating the company tactics level. But in terms of strategy, I do not think we have any change. So the key reason is for us, let's say, what is CVC or VC? We're typically talking about 10-year cycle-ish, right? More often it's even longer than that. So what that means is very likely we will come across at least 2 different administrations, more likely 3. So if we are not betting on the fundamental economics of technology, but betting on a specific regulation or incentives, I think that's the wrong bet. So this is why we always look at what will change the world or have a big impact to our industry in the next 5 to 10 years, rather than specifically focus on where's the incentive. That's the fundamental investment thesis. So that doesn't change. We're still investing in the materials, decarbonization, sustainability, a lot of things. What has changed is, for example, as we're talking to a specific startup in the space, when they present to us about their techno-economics, a clear question we're going to ask is, okay, do you have any specific regulation, incentives included in your model? Do you betting on the specific sectors that you think will take off this year or next year? So that will definitely have some change in that level. When we support our portfolio companies, so we may advise them regarding, maybe there's the fund non-dilutive grant for certain sectors may be getting lower or getting dry. So they probably need to think about some other ways how to make sure they can meet their goals and also support the government in different ways. So on the technical level, yes, there has been some change, but broadly speaking, not too much.
Okay. Now, you had mentioned to me in a prior conversation that your group does not just syndicate or invest in funds, although you have the freedom to do that, but you will also lead. So how do you tech scout for those opportunities? And then how do you bring in, say, VCs or other CVCs into your target?
That's a real good question, Kevin. If we specifically narrow define tech scout, I would say it's actually the same, because we talk to innovators, this or that. So we don't screen them because we couldn't lead their deals or lead their deals. We keep talking to people in the network, keep receiving inbound, and also do our proactive outbound research as well to identify the best innovators or not, right? Whether they, see whatever approach makes most sense. However, what definitely has been slightly different is the way we interact with them, and also especially whether there's a good fit in terms of transaction. I think for a corporate VC to be a lead, basically there needs to be 2 different things, right? So the first is that specific team needs to be equipped, or they know how to lead the transaction. That's number 1. And number 2, there is a good fit between the CVC and that specific portfolio or that specific target, and there needs to be a fit. So the reason why a lot of CVC out there, they don't take active leading position is mainly because having a CVC being sits over there on the lead as a lead and have a board seat, sometimes we will have some people will read that slightly differently, depends on which table you come about. I have seen people seeing that, let's say, a CVC leads a transaction, so that specific startup must be a pet project of the corporate, right? So there definitely has been, whether it's true or not is up to debate, but there's some visions or visibilities around that. So this is why for startups, sometimes they actually very cautious about that. With that said, there are also clear benefit corporate venture lead transaction. The first is corporate venture today is very different from corporate venture, let's say 20 years ago. So 20 years ago, people still call CVC as what they call like tourist investor. Basically, they come and they go, right? And also a lot of time, it's not a really clear carved out team So sometimes you see M&A people leading CVC, sometimes you see corporate people sit on the board. So, but over the last 10 to 20 years, there has been a lot of professionalism nowadays. And also CVC has grown as a category and a VC. Depends on which statistic you're looking at. Nowadays, CVC contribution in the broader VC ecosystem is at least 20%. So that's already very sizable, which means nowadays the CVC behaves it's actually a professional. We call ourselves, this is a professional game. This is a professional sport. So this is not just a random guy, you go there, you do a CVC. This is already professionalized over the past 10 to 15 years. So this is how I think nowadays people higher respect regarding CVC and trust the CVC than before. Again, there's still some things on and off here and there, but I think that's quite common, not just about GC venture like us, but also happens across the board for CVC as a vehicle out over there.
Right. Well, actually, that's an excellent segue because, as you informed me, you had recently chaired a panel at the annual Global Corporate Venturing Investment Symposium, GCVI. I wasn't as familiar with them as I am with the NVCA, right? So tell us a little bit more about GCV and what was the focus and goal of your panel?
So I'm not sure if, the audience podcast is familiar with. So there is a group called Global Corporate Venturing or GCV. I know it's very confusing because we're also GC Ventures, but there's no formal affiliations between the two. So they are the de facto CVC industry associations. So basically they try to group CVC together and organize event for CVCs, peer CVCs. They are industry agnostic. And they are holding events everywhere globally. And annually, they have their event in Monterey, which it depends on year, 700, 800 CVCs being there, discuss a common challenge. Okay. It's pretty big. So over the last 2 years, I happen to be the chair for their energy council. So basically supporting them and helping them a lot of, and also organizing event on a lot of the activities along energy. So that's kind of how I got involved as a volunteer. And then wearing that hat, I think we've been doing quite a few different events and panel discussions or webinars along the topic of energy. So for the annual event, we held a panel discussion about energy as well as AI. Basically, data center is a big driver for that. So how we deal with that properly was the industry consensus. Is there any consensus around that anyways, right? And then more recently, early September, we actually have an in-person event in Houston where about 40 to 50 CVCs locally had meet up together. It's half the event. And over there, we have maybe 3 or 4 different panel discussions that we, together with the GCV team, we put together. So the topics is anywhere between scaling up, how to scale up a deep tech technology, energy infrastructures, the IP rights, how to work with universities, the things like how, as a group, what are some of the hot topics and of these trends of decarbonization, how people dealing with that. So these are the few different topics we touch upon in the Houston event. Again, combining those two events, I think that's the hot topic and in the energy ecosystem today.
With respect to the discussion on this most recent panel, I mean, you mentioned AI and things like that, but what were some of the panelists seeing and what was your takeaway?
Out of that event, basically, we have invited people along the supply chain, both as, data center builders, the big cluster, the actual, who are actually building the data center, like building the clusters physically, and as also as the operators of those, some of the big, owners of the data center, as well as some of the people down the supply chain. So I think the key message we've been seeing is that number one, everyone is seeing AI is coming, and number two, AI consumes a lot of energy, and number three, how to address the energy need is still a big question mark. We can, again, on itself is a huge topic that we can dive even deeper. But roughly speaking, I think people are very excited about that. However, depends on the region, depends on where you are sitting in the supply chain, and also your investment mandate. People may have to tackle that very differently. It's not just one shiny object. Everyone knows that happening and everyone will make money. It's not as simple as that.
Right. Well, there's been a lot of talk about and sloganeering, energy for AI, AI for energy, but sitting where you are working for PTT, I mean, what are some of the material opportunities, advanced material opportunities that you see kind of associating with data centers and energy efficiency?
I'll probably break into a few along the supply chain, right? So first, there's the energy generation piece, right? So I think, again, depends on timeline we're talking about. So there's a lot of longer time frame, Horizon 3-ish investment, and that has been happening. So for example, one of our sister fund, they have invested in a fusion. That's definitely can support when it happens, right? And then there's definitely a lot of things happening on the grid, because, for example, in the US market, a grid has been a big bottleneck. We know that in the US market, unfortunately, the grid is a little bit outdated, infrastructure is a problem. So how to get the energy, online, offline, this and that is a big challenge. So we are seeing a lot of innovation happening along those lines. And then there's also the things happening at the data center level. So there's one specific thing that I can mention on the material side is one of my portfolio companies called Boss Materials. So they basically have a carbon fiber enabled thermal interface materials, basically to help the chipsets to dissipate their heat into the heat exchangers, and then so that the downstream cooling mechanism can recycle and have better efficiencies from that level. So there are definitely a lot of things happening along those lines.
Right. Well, there's a lot of excitement about cooling technologies, and especially for our APAC-centered data centers. Completely different from what we see in the Nordics, where basically you're seeing heat as a service as business model. Now you actually want to go the opposite direction. So this idea of redesigning chips, redesigning the data center, and of course introducing advanced materials is really kind of a hot topic there. So one last question on that then, is that an area that you see kind of deepening in terms of looking for novel materials that can fit the bill for data centers and increasing kilowatts per cabinet, right?
There's definitely a lot of things we can do from the material innovation side. And another, again, I don't want to feel too salesy, but another portfolio company that we have invested in is the one I mentioned, Actionable. So they do waterproof coating for PCBs, right? So again, that's definitely very helpful in liquid cooling. Again, we can always argue whether water is the best liquid over there or some other thing is better, but still you need to protect your electronics better in the fluid. So that's something that Actionable can definitely help and support.
Okay, fantastic. So, well, another gear shift. I think you were recently in Asia, and given that you work for a Thai-based company, I'm sure you're comparing, contrasting between there and North America. So tell us about some of the things that you see in the APAC region that you see is exciting.
That's a good question. I think a lot of things are very exciting. I think on both worlds, right? So I think before I comment that, it's probably, there's a pretty popular book nowadays called Brick Neck by Dan Wang. So that specific book is exactly on that topic. So the author spent decent time both in China as well, in Asia as well as in the States. And I think that's kind of one of the best sellers nowadays, talking about doing, I think that's probably, it's their job to actually do the compare and contrast. But I think the key takeaway, right? I probably use China in that specific context following that book is one of the key takeaway they have is China is an engineering state and the US is a loyalist state. So my translation of that is China is very result or end driven. However, the States as of now is very process driven. So again, I'm not saying, I don't think I agree with all the observations or comments in the specific book, but that's basically the key idea. And they have a lot of use cases, examples, how, that has actually happened. And moving back to question, Kevin, I think this is where I think for me, I have been learning over the years, even though I'm born as a Chinese, now working for a Thai company, is that Asia is such big place that it's not one market. It's not one thing. And each region has its own unique things, right? So for example, over the summer, I spent probably more time in Thailand. And over there, I'm still seeing growing populations when I visit. I think we talked about this while we chat. So while I was working in the shopping malls, super excited, young people just walking around, they buy stuff, right? So you definitely see the super consumerism is booming over there, which will drive a lot of the market, a lot of things all happening over there. And I also see that in many parts of Asia. But then there's also other parts like Japan, like Korea, which are much better developed, and then they have their own things they're worrying about, right? So again, so that's kind of how I'm seeing. I'm not sure if that's even answer a question, but I'm definitely seeing the excitement of the growing market, growing consumerism over there across the board. And how does that translate into business opportunities for PTT, for PTGC, for my venture team? I think that's still something that we're very actively evaluating. But I think if we're talking about something that can follow that population growth, if that's something that can improve productivity, if something that can improve the sustainability, reduce carbon footprint, I think these are some of the high-level things I trust won't go wrong.
Right. Well, on that note, I mean, I do follow Cushman & Wakefield a little bit because, of course, they're a big real estate player. They have a big global footprint, but they also have a really nice data center analytics group. And I was a little bit astounded to find that they actually have a metric where they are measuring I guess I'll call it the per capita per megawatt of electricity usage, especially in data centers. So currently for Thailand, it's about 800,000 people per megawatt, but they forecast it going down to 220,000. So that means a fourfold increase in data center capacity between now and 2030. So Thailand is not a place that one naturally thinks about as being that advanced or that rapidly growing, but apparently it is. I mean, what are your thoughts on that?
Thank you, Kevin. That's a really good question. I think clearly, as we discussed earlier, is that there's very clear, strong market need for AI, and which has been translated into energy for AI. And I think this is where people start to get a little confused, is about what can happen this year, next year, versus what can happen in 3 to 4, 5 years, versus what can happen in 10-year time frame, and how does that translate to an investment vehicle like us, which is a venture kind of play? Because these questions will answer and address that very differently. So what we have been seeing is that at least in the very near term, we are not expecting that the next generation technology are mature enough to get adopted or commercialized in a very big scale. So we're definitely very excited to see interesting pilot going on anywhere from new, I would say, motors, new turbines to fusion, right? So, but on the other hand, so this is where you'll probably hear, for example, companies like GE Vernova, who is a major energy equipment supplier, has been, again, this is in public domain, has fantastic POs over the next few years. They pretty much sold out for the next few years. So that's kind of what we'll see in the near term to address that specific need. But then the key question that a lot of venture people like me, that we're asking is, how about after that? What will happen after that? How to drive that? So that's kind of I don't think there has been a clear consensus around that line. So there has been a lot of different approaches. And also, I think we need to be clear that in the past, when we talk to an energy supplier, utility people, they only ask about two questions. The first is about cost. The second is about resilience, basically how stable they can provide, because their job is to deliver energy cheaply and reliably. But today, in the market, in a world like today, there's a third thing added on top of that, which is sustainable. So people also want to have, lower carbon footprint, lower impact to the world. So that what we're seeing is that people understand how to do the first thing together using existing technology, but people don't know when the third criteria is put on top, how to do that properly. It's very difficult to achieve at the same time. So that's kind of how you see that a lot of things that people nowadays are doing, especially from venture group, is we want to invest in things that can address the three problems, hopefully at the same time, if not at least two of them at the same time. So that's kind of how you see. Again, translate that into Thailand or Southeast Asia. We're seeing that as well. We do not envision, to be totally honest with you, as a developing country, we do not envision or see that Thailand will be the first country to adopt a super futuristic technology over there. Very likely, what they will do is they will adopt mature technology today, start to pilot incremental innovations gradually, and then when the futurist technology people are developing today got to mature in the next 5 to 10 years, then they can be a fast follower in those markets to address the need that you mentioned. So that's also the reason why, again, I'm not sure if this is relevant. This is also the reason why, for us, we decide to build our venture team here in North America, because this is the market where we see the highest innovation density is happening. We're very likely, advanced technology being first developed over here. And also, we're seeing this is likely where the first generation of the futurist technology going to be adopted and tested by the market so that we can hopefully support them properly. And then along the way, we have the front row seat and hopefully can work with them faster in Southeast Asia.
Okay. Well, let me see if I can tie this back to some of the early comments about supply chain, because I think there's an interesting insight there. 10, 15 years ago, I was doing a lot of work in Southeast Asia for the bioeconomy, which was going to explode, right? And 20 years on, we're still kind of waiting. There's been a few wins here and there. But you obviously have some investments in this space, so you still believe in it, and you talked about Horizon 2 and 3. But I think it's also about adoption, and you also mentioned techno-economics. So and of course, Southeast Asia has an abundance of bio feedstocks. So the question, I guess, is when and how, and how do you invest if you're thinking about H1, H2, H3, and then you're looking for unlocks and downstream off-takers, right? The right techno-economics. So it's a broad question, of course, but what are your thoughts on bioeconomy?
Yeah, thank you. So first, both PTT, GC, and myself, we are strong believer of that, because as going back to some of the earlier conversation, because we see that's a necessary piece to enable that energy diversity or feedstock diversity. We see it's definitely, it's needs to be a piece. That's number one. Regarding the specific timeline, to be totally honest with you, I think no one really has the crystal ball to that. And so it's really down to us is about how we can select technology or support technology that can mitigate that timeline risk. I think everyone has their own vision and their own version how to do that. For us, our approach is we prefer to invest in platform technology. The key rationale about that is we don't want to bet on a specific product, because product, especially if it's on a commodity, very likely will be following the commodity cycles. There's good years or bad years, and you'll be crushed out if you happen to be in the bad years. That actually would happen in 10 to 15 years ago in that wave of bioeconomy, because everyone's looking at that. We want to make a certain bio-based version of a petroleum commodity. And when petroleum price goes down, the whole industry is pretty much, I wouldn't say all, but most of them are wiped out. So this is where we prefer to invest in something that can have multiple products and then have a well-developed roadmap across the whole years. Hopefully, some of the early applications are higher margin, and then give them enough runway to address the market to survive, further develop technology, and then down the line, they also have something that a lower margin but bigger volume play, so that along the way they can actually prepare themselves towards that. So that's kind of approach at the team level how we want to deal with that more on the technical level. But the strategic level, yes, I think full along, we still think that's happening, but we just need to be selective about what we are backing.
So in addition to investing in, great platform companies, there's still the go-to-market at the end. And I would imagine that what PTT brings to the table, in addition to capital and know-how, is being able to unlock those downstream markets, either through complementary investments or through your network.
Yeah, totally. Thank you, Kevin, for mentioning that. So this is exactly what's some of the value that we can bring in. I don't think I can comment on specific on my CVC portfolio, but GC, one of our joint venture with Cargill, is a company called NatureWorks. So they are one of the biggest supplier of bio-based as well as compostable plastic called polylactic acid, PLA, out of Minnesota. And GC has been a shareholder of the company over the last maybe 12, 13 years and have been supporting company along the way. And maybe 2 years ago, we made an announcement that we are helping NatureWorks to secure feedstock in Southeast Asia, and we are working together to build their second commercial plant in Southeast Asia. So that's kind of an example of the value, how we are supporting them, where we work together to secure funding, to secure feedstock, to secure the end down market where we have access to.
What are some of the things that you see out there that, it's easy enough to talk about, hey, in 10 years, this could play out 20 years, but, for the next 5 years, what do you see are the most exciting investments that, we'll actually see some returns by 2030?
If we are talking about time frame is by 2030, so which is within the next 5 years, I would say from a venture perspective, pretty much doing anything now is pretty late. So for anything is pretty late. However, if we're talking about something that in the near term that I maybe something that can at the inflection point. I would say, I think no one has a crystal ball, but I do think there has been a lot of involvement or progress I'm seeing on the robotics side. Because for the hardware side, there has been a lot of improvement. However, the brain has not really been advanced enough. But with all the AIs coming in the last 2-3 years, but it seems like the brain are getting smarter and smarter and smarter. So our expectation is there may be something along the line for robotics, especially in industrial setup. So for the actual consumer face, I'm not sure. I'm not the expert in that. But if we're talking about on the industrial setup, I think there may be something that can significantly help efficient improvement.
Well, that would be exciting.
Yeah, you're totally. We're definitely monitoring that space a lot, how we can, whether there's something along those lines can be adopted by the energy sector. So again, that's definitely one thing. And we still have high hope for the bioeconomy as we discussed. But again, it needs to be selective. So we probably need to be selective, understand what we're doing, and bet on certain platform that can achieve higher margin activities first. And yeah, I think these are probably two things that coming to my mind.
Great. Well, hey, Tony, it's been great to catch up and speak with you here. Thank you very much. And if you'd like to continue the conversation with us or with Tony and learn more about GC Ventures, please feel free to reach out to Tony or to contact FSX via our website, FutureScaleX.com, and hit the Contact Us button. Thank you again, Tony.
Thank you very much, Amy. Thanks again.